Today, we will talk about bottom-up investing, definition, example, versus top-down. Bottom-up investing is an investment approach that focuses on analyzing individual stocks and de-emphasizes the significance of macroeconomic and market cycles. This means that bottom-up investing involves focusing on a specific company's fundamentals, such as revenue or earnings, versus the industry or the overall economy. The bottom-up approach assumes individual companies can perform well even in an industry that is underperforming, at least on a relative basis. This investing approach forces investors to consider macroeconomic factors, including a company's overall financial health, financial statements, the products and services offered, supply, and demand. The bottom-up approach is the opposite of top-down investing, which first considers macroeconomic factors when making an investment decision. Making sound decisions based on a bottom-up investing strategy entails picking a company and giving it a thorough review before investing. This strategy includes becoming familiar with the company's public research reports. Most of the time, bottom-up investing does not stop at the individual firm level. However, the investment research process begins at the bottom and works its way up to include the industry group, economic sector, market, and macroeconomic factors. Bottom-up investors usually employ long-term, buy-and-hold strategies that rely strongly on fundamental analysis. Bottom-up investors can be most successful when they invest in a company they actively use and know about from the ground level. Meta is a good potential candidate for a bottom-up approach because investors intuitively understand its products and services well. Once a candidate such as Meta is identified as a good company, an investor conducts a deep dive into its management and organizational structure, financial statements, marketing efforts, and price per share. Next, the analyst compares Meta's financials with that of its competitors and industry peers in the social media and internet industry. Doing so can show if Meta stands apart from its peers or if it shows anomalies that others do not have. Once all these factors are built into an investor's decision starting from the bottom up, then a decision can be made to make a trade. Bottom-up investing starts with an individual company's financials and then adds increasingly more macro layers of analysis. By contrast, a top-down investor will first examine various macroeconomic factors to see how these factors may affect the overall market and therefore the stock they are interested in investing in. They will also look at the performance of the overall sector or industry. Top-down investors might also choose to invest in one country or region if its economy is doing well. Bottom-up investors will research a company's fundamentals to decide whether or not to invest in it. On the other hand, top-down investors consider the broader market and economic conditions when choosing stocks for their portfolio. Here are 3 key takeaways. 1. Bottom-up investing is an investment approach that focuses on analyzing individual stocks and de-emphasizes the significance of macroeconomic and market cycles. 2. Bottom-up investors focus on a specific company and its fundamentals, whereas top-down investors focus on the industry and economy. 3. The bottom-up approach assumes individual companies can do well even in an underperforming industry. Hope this would help. Thanks for watching.